We've got an extra 25% of properties on the market. Things have started to tighten up after getting these elections and the interest rate reduction out of the way and behind us. We're entering this second growth phase. I'm getting offers again on most properties before the first weekend, some of them sight unseen, and I'm selling most properties all decently above the asking price at the moment, whereas things did cool off from October to March this year. I'm thinking that these first home buyer incentives are going to spark the lower end again. I think we're going to get a solid middle, and it seems like the upper end, a bit of money is coming back with confidence now that interest rates have started to decrease. So that could be also, we could have a three-pronged market growing strongly again. Government announced changes to their low deposit shared home ownership program, where the government would co-own the property up to they'd own up to 35%. These changes come through from September, not only to established properties, it can be applied now to new and under construction apartments, townhouses, and other multi-res dwellings, allowing first home buyers to get into those more affordable other property types.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to my Perth property market update for June 2025. It's been a really cold, wintry week, but the market is seriously heating up out there now that we've got both elections out of the way, the state election, the federal election, and we've had an interest rate reduction. It's really interesting to see what the effect has been on our sale market, our rental market, and I'm going to take you through the factors that are affecting both, as well as the outlook ahead and what's predicted. So let's jump into it, shall we? On the sale market side, we have now got 4,073 properties, which is very, very tight. We've had a decrease over the last 2 months, particularly over the last month, it's tightened up. Now, compared to the same time last year, we've got an extra 25% of properties on the market, but things have definitely started to tighten up after getting these elections and the interest rate reduction out of the way and behind us. So we're definitely entering this second growth phase. I'm getting offers again on most properties before the first weekend, some of them sight unseen, and I'm selling most properties all decently above the asking price at the moment, whereas things did cool off from October to March this year. And I was, wondering, were they going to kick up again? The interest rate reduction certainly has helped that. Having the certainty and the confidence that what we're doing at a state government and federal government level, whether you support either party, people just love certainty and having these things set now, we can all proceed with confidence. And I think confidence is also building that we're no longer in a cycle of increasing interest rates. And we've also got a lot of first home buyer incentives that have come out, which I'll run through in a minute, that are fueling the bottom end of the market. We've also got the bottom end of the market with all of their equity having increased. They're trying to upgrade into the middle of the market. That middle of the market's super hot right now. And that's going to really push up prices in that middle. And our rental market is hanging in there very tightly as well. So let's go through some of the details. Number for sale has started to drift back and tighten up over the last 1 to 2 months. Still a bit more supply compared to last year. Number being sold each week is still high. We had 934 properties getting sold last week. We had a bit of a dip across February, was one of our lowest months in probably over the last couple of years. Over the last 3 years, so we really did take the wind out of our sales in Feb. But when we compare with the same time last year, we've had a 13.7% increase in the number of properties getting sold per week. So that's definitely going to keep tightening up the supply and putting pressure on prices increasing. Now, when we look at the sale inventory, we're at just 1.1 months. It hasn't really gone above 1 month for the last couple of years. So very tight overall inventory. And the inventory is how much supply is in the cupboard of properties on the market compared to the rate that they're being bought. So at the current rate, we've got just 1 month of supply, and really that's a super tight market that is definitely going to keep putting pressure on prices. So what's been happening to the median house price? Since I came to you in March, things had gone up another 20K to 780K. We're about to cross that milestone 800K bracket for the first time. So that'll be a bit of a monumental crossover when it happens. And compared to the same time last year, we were at 661,000 last year for houses. So about 120,000 increase in the median house price over the last year. When we look at what's happened to units, they've almost correspondingly increased by as much. They've increased by 90 odd thousand, increasing from 442 to 535. And the land has started to edge up more and more, increasing by about 80K, 77K, from 273 to 350K. So fairly big movements in all of our median prices over the last year, and that's expected to continue. So albeit at a slower rate, I should mention. When it comes to the median selling days, we actually had a bit of a tick up across the 2 quarters, finishing the year in the December quarter and also the January, February, March quarter. So things had ticked up to 16 or so days, average sort of selling time to sell. They've now tightened back to 13 days. So super tight. The tightest market we've ever had was at 8 days. So we'll see if this starts to trend back towards that 8. Either way, incredibly tight market, which means that basically most properties are selling in 2 weeks of being on the market. And in my case, my vast majority are selling in the first week. Now, let's go through the Perth rental market, see what's happening there. We've got 2,426 properties for rent, so still incredibly tight. That's a 2.3% decrease since June 24. So we're actually down on the number of properties for rent since June 24. Had a little bit of a spike up around August, September last year, but that has been tightening up ever since then. Our number for rent with Investors Edge is just 19 properties out of 1,100 odd properties that's in our portfolio. So very tight overall rental market still. When we look at the rental vacancy rate, I see different vacancy rates being thrown around, but I use SQMs because it's the most widely reported, and that's showing 0.7% still across the whole of Perth. So, but what I am seeing at the individual suburb level is that some suburbs have started to drift up to that 2 to 2.5%, where they're representing more of a flat market. So usually when we get around 2.5% vacancy, the pressure on rental prices stops, and you really need to be the best priced, best marketed property to attract tenants in a timely fashion and limit your vacancy rate. So it really goes case by case, both with the rental market and the sale market. So make sure you take advice from us when you're looking to sell or rent in any of in your specific situation. So we've had a 16.7% increase since June 24, the same time last year. So slight increase in the vacancy rate, but it's so tight. Our actual portfolio with Investors Edge Real Estate is with a vacancy rate of just 0.3%. So super tight still. Now, the median rent for houses has edged up another $5 since I came to you in the March. So we're at 685. So good to see that that's still edging upwards. That's a 5.4% increase since June last year. And the median rent for our overall portfolio at Investors Edge is $650 per week. So that's continuing to tick up as well and chase the overall median for the market. So I expect the rental prices will continue to increase, but at a slower rate as well. I'll run through my specific predictions towards the end of today. Now, let's see what else is going on. Rental inventory has remained super tight at just 0.92 of a month. It's a 13.3% decrease since June. So even though the market has had a lot of investors sort of come to it, it's remained very tight and continues to have properties getting taken up quickly, and the inventory remains very low. So that's going to keep putting pressure on rental prices. Now, let's take a look at the property clock for the timing of what's happening to the capital cities around the country. The only big change since I came to you in March is that Sydney has supposedly moved around to starting of recovery, which is interesting. That seems to have moved through its cycles a lot quicker than its neighbouring city, Melbourne, which is still in a declining market. They're in a real sort of woeful state with their state government. Their Residential Tenancies Act is putting a lot of investors off. Their land tax is putting a lot of investors off. But it does represent a good opportunity over the next 2 to 3 years. It'll be like Perth, and it'll stay down for longer than people think. And then when it gets going, it'll probably continue for longer than people think. But with regard to Perth, we're still categorised as being in a rising market. Our southwest of WA is still in a rising market as well for houses. And then when we look around at units, Perth's still in a rising market for units, and there's no other major changes to most of the other capitals besides Sydney. Units have been recategorised as getting to their bottom of the market. Now, let's take a look at what's actually been happening to the CoreLogic index around the various capital cities over the last 3 months. This is a bit of an indication as to where there's pressure on prices and where's sitting flat. So Darwin has been finally getting its time in the sun. There's a lot of investor activity up there. It scares the hell out of me to ride that roller coaster, but it has had 4.3% over the last quarter. Perth's had a very solid 1.6% despite everything that was going on with the elections and the pause on things. Adelaide 1.3, Brisbane 1.6. So Brisbane and Perth have been the next highest capitals with 1.6%. Melbourne 1.2%. So that has started to show some early signs of recovery, and that's mainly because investors are getting into properties in the sub 650 price point. Now, the digital horde doesn't have much money to spend. They've all got low budgets. They move around. That's why they're looking in Darwin, why they're looking in Melbourne. My appetite is much more for the 800 to 850 sort of price points in both Perth and in Melbourne. We're starting to look at. But I think Perth represents the best opportunity for the next 1 to 2 years, and Melbourne, as I mentioned, over the next 2 to 3 years. And Sydney's shown some positive increase for the first time in a while, 1.1%. So it's interesting that the Heron Todd White's coming out and labelling Sydney in a growing market when it's had still lesser increase in the CoreLogic index than Melbourne has at 1.2, yet Melbourne's still in a declining market. So go figure. I don't know if Sydney's quite around to that yet, or maybe Melbourne's further along than people think. But it's always markets within markets. And when you try and label a whole city, it certainly doesn't represent what's going on underneath the surface. Now, the 12-month changes, we had Darwin with 3.9%, Hobart 1%, Perth 8.6%, Adelaide 8.6%, Brisbane 7.1%, Melbourne had lost 1.2%, and Sydney had gained 1.1%. So Perth still the standout there, along with Adelaide. Adelaide's had its second wind. It's had its third wind. It's continuing to edge up there longer than everyone thought. And that's become a fairly stable sort of growth there on the back of a lot of government sort of spending and defence going into there. Now, when we look at the capital cities and which segments of the market have been most active, Darwin across the board has had the highest increases, both of the lower end, the middle end, and the upper end, with 4.3 odd % increase in prices to each of those market segments. When we check out Perth, the lower end has still continued to be the standout performer, which is interesting because I'm definitely seeing more of that shift to the middle. So it's saying here that the CoreLogic index has had a 2% rise for the lower end, a 1.2% rise for the middle, and a 1.8% rise for the upper end. So it's tracking some pushing and some movement at the upper end and the lower end, nearly twice as much as what's going on in the middle. So I think that'll be interesting to see how that pans out, because I'm definitely thinking that these first home buyer incentives are going to spark the lower end again. I think we're going to get a solid middle, and it seems like the upper end, a bit of money is coming back with confidence now that interest rates have started to decrease. So that could be also, we could have a three-pronged market growing strongly again. Now, when we look around the other capitals, it's mainly the lower end in every market that is growing the fastest in Brisbane, Adelaide, Perth, Hobart, and and in Melbourne. Now, the only sort of counter to that is that the reverse is happening in Sydney. So the upper end is what has been increasing in its prices, then followed by the middle and then the lower end. So their recovery, it looks like, is going to be sparked from the upper end first, where the money is. Now, when we look at the different rental yields on offer, this definitely plays a factor in investors, and how attractive each of the capital cities are. So interestingly, Darwin is at a very high 6.6%. So people are chasing yield up there. The risk comes along with it. When we look at Perth, we're at 4.3%, so slightly decreased compared to the March when I came to, which I think was at 4.4. Adelaide, Brisbane, and Melbourne are all at 3.7%. So it's going to cost you more to hold a property there than in Perth. And Sydney's at 3.1%. So still very hard to hold property in Sydney, especially when you consider the price points and just how negatively geared you'd end up being. So that's the rental yields on offer in each of those capitals. And when we look at deeper at the factors that are affecting our market, I like to look at our overall economic clock for Australia. Now, we've moved around to about a 7 o'clock where interest rates have started to fall. So that typically then flows around to rising share prices at some point, easier money being available, and then rising real estate values. So we're only sort of fairly early in that typical economic clock and the stages that are ahead. We've seen the share market have a decent comeback from its lows when Trump initially came out with his trade wars. I'll go through that in a minute. But let's first touch on what's happening with finance.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events, including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
You would know by now that we've had a second drop in the official cash interest rate by 0.25%. The majority of economists were expecting a 0.5% reduction, but the RBA looks to have tempered things and not gone the full for as big a reduction. And I think I know why, and I'll tell you in a minute. The cash rate is now at 3.85%, and we had the first reduction to the cash rate back in February, which is a 0.25%. So we've had two reductions so far this year. The neutral cash rate is considered to be between 2 and 3%. We're currently sitting at 3.85. So really, to get back into that sort of more neutral band of the interest rates, we've got 0.85% to move, and then that would longer term be considered a bit more neutral. The actual rates on offer at the moment are 5.75 to 6.25 is fairly typical. So check your interest rate. If you're not within that sort of band, you'd want to be reaching out to your finance broker and seeing what they can do. The ASX futures is pricing in no further rises and expecting a 0.75% decrease further over the next 6 months. So that would be 3.25 decreases to take us more in line with that neutral rate. So hopefully for all of us that do have lending, that does come to pass. And for every interest rate reduction, I think that's only going to further stimulate the property market, allow more people to get in, allow more people to borrow more, and more people to have the confidence that in taking out a loan. So if you're watching the video, you can see that we're still relatively low compared to our long-term averages with the interest rates, and the interbank cash futures when we look forward what the share market's basically predicting for the interest rates, once it hits that low in over the next 6 months, they're predicting it to stay there for the next couple of years at the moment. So interesting to see what the market thinks. Now, when we look at the actual inflation, and this is probably one of the most important things that the Reserve Bank is keeping an eye on, we are now at 2.4% for the year to March, which is very back down to those low levels. They want to keep us within the 2 to 3% band. The peak of inflation was at 7.8% in December of 2022. So we're about a good nearly a quarter of that. However, last quarter, the inflation spiked up a bit to 0.9% after 2 quarters at 0.2%. So that, I think, contributed to giving the RBA a pause and not going as aggressive on reducing interest rates. And the biggest increase in the consumer price index that give us that uptick in inflation was from education increasing by 5.2%. So still costing a lot to get yourself educated, and interesting that we haven't sort of fully put inflation behind us, even though most people are expecting that it's going to remain much lower and we're on the right track. So when we talk about what's happening in the stock market, it was pretty scary what was happening only a month ago. We were hitting new lows for over the last year. It had pretty much wiped off most of the gains we were below where we even started the financial year at. We're now pretty much back on par, and we've had a 9.26% increase over the entire financial year, but we're back on par with the highs that we had before Trump came out and started his whole trade war. So imagine if you'd sold during the low there and the money you would have missed out on in the recovery. And that's why you really just need to make sure that you don't buy too much into the media and panic in these kind of situations. And the same goes with the properties that you're holding. Don't make any rash decisions. When it comes to the iron ore price, we're at $94 a tonne, and that's still trending relatively sideways. So nothing major to report in that front. I like to monitor that one because of how important iron ore is to our state. But I think from what I've heard, especially when I was talking to Tim Reardon, a lot of our contracts are locked in for the longer term. We're in a maintenance production mode now, so we're not likely to have as big as swings to our overall property market and overall resources sector as a result. And it was very encouraging to hear Tim's insights if you want to go back and listen to his episode a couple of episodes ago, where we covered what's ahead for the Perth property market. And it was incredibly insightful that he thought we're definitely not going to keep riding the roller coaster like we used to, and that we're going to have a more normal cycle ahead compared more similar to what the other capital cities have. So that was very encouraging. Now, when we look at the population growth, which has been released now to September 2024, Perth was still leading the way with the highest percentage change over the last year to September 24. So we had a 2.5% increase, highest by percentage terms. The next highest was 2% to Queensland. So Perth's still being favoured as the favourite place for migrants and overseas migrants and interstate migrants to come. So that's going to continue to put pressure on our rental market, most importantly first, where people come to rent, and then those renters will flow through to putting pressure on our sale market, and there'll likely be more demand than there is supply for the foreseeable future. And that was one of Tim's other points that he went into in detail, so check out the episode. Now, when we look at where this population growth is coming from, majority of this is from net overseas migration, but there still is interstate migration coming predominantly from New South Wales and the Northern Territory across to Queensland and WA. So a lot of that, I think, is driven by the lack of affordability in Sydney to, get a home and have that dream. And people are moving to Queensland and WA because of the job prospects on offer, the relative affordability, and the relatively high incomes and lifestyle aspects that are really Perth and Queensland is known for. Now, let's run through the policy changes and impacts for WA. because we've finally got the state and federal government elections behind us, thank God, and we're starting to get a lot more specifics on the various things that have been rolled out by our state government. They had their budget announcement yesterday at the time of recording this, and they've come out with their first home buyer financing changes. So they've got these new loan products for modular construction, which I think is fabulous. It's a low home loan product with a low deposit, and where they can put in just 2% to finance the land, the construction, the transport, and the connection of a modular construction home. I don't know how many builders there are that can do this, what sort of prices that they're working out to be, but hopefully with the stimulation in this area, it can actually translate through to extra housing being built quicker and more cost effectively. So I might end up doing a bit of a deep dive on that one coming up. The government's also announced changes to their low deposit shared home ownership program, where the government would basically co-own the property up to they'd own up to 35%. And these changes come through from September, and it's basically allowing this to apply not only to established properties, which was the case, it can be applied now to new and under construction apartments, townhouses, and other multi-res dwellings. So basically allowing first home buyers to get into those more affordable other property types. And I think that's a good move as well. How does this work out to be better for the first home buyer? Because they don't own the whole amount, they have lesser repayments, while they still get that sense of home ownership, they still get a stake in the property that's growing, and they can then sort of choose when and if they can refinance out the government. And because they only need a lower deposit to get in, they also don't need lender's mortgage insurance. So that's a big positive of not having to come up with that as another barrier to entry. So there's certain qualifications, only lower end incomes and people that are a bit more disadvantaged can afford, can qualify for that. The government's also announced that they're rolling out a graduate and apprenticeship low deposit, low interest repayment type loan. I think that's fabulous. So that's going to be coming out later this year. And details are still to be announced of exactly what that is going to involve. Finally, we've had changes to the transfer duty. So there's going to be no duty payable on homes valued up to $500,000. So they're basically changing the thresholds here, and that's going to save eligible first home buyers nearly $18,000. And they're going to have a reduced rate now that applies between $500,000 and $700,000. So you can bet that everything below $700,000 is going to be really pushed up by this, because first home buyers want to make sure that they qualify for at least the lesser reduced rate. And I had the situation on the weekend when you're negotiating and you hit one of these limits, first home buyers are very reluctant to go above. I had a buyer offering me to give the seller cash on the side, which I've never heard of in 17 years, and certainly couldn't look to accept it at all. It needs to go on the contract and be legitimate. So 700,000 is going to see first home buyers sort of cap out at that price point now, because when they go higher than that, they'll have to pay the full duty, I believe. And so that is really going to be a ceiling to where first home buyers are wanting to go for prices that they pay, but it's going to move anything in the 600Ks up to 700K very quickly. Now, for first home buyers purchasing vacant land to build their first home, they will not pay duty on the land now valued up to 350K, and they'll pay a reduced rate between 350 and 450. So that's going to, all those things going to open things up for first home buyers and really stimulate that end of the market. Now, tips to survive and thrive in this market. Still good value buying, and there's solid rental yields on offer, but you definitely need to be a lot more selective now. Previously, you could throw darts at a board and do well. You have to be super selective. If you're just randomly coming up with the areas to invest, as opposed to our data-driven trifecta criteria approach, then of course we're going to be selecting high-performing properties and have the best chance of doing that compared to what you might be able to achieve. So if you've got the budget to go into the middle or top-end suburbs, they're likely to experience the most growth over the next 1 to 2 years. But if you've got a budget that's below 700K, I would still be getting into a villa or a unit, because you can still get into prime locations that are likely to have strong growth over the next 1 to 2 years in villas and units. And that's what I'd be doing if I had a budget that was sub 700. Speak to us about our buyer's agency service if you are looking to buy your dream home or investment. There's so many ways that we can save you and pay for ourselves many times over. So make sure you get in touch. Even just getting you into the market 1 or 2 months earlier is going to pay for ourselves, preventing you from overpaying for a property, buying in the right area that's going to have the best chance of achieving growth, both in the short term, medium and long term. We can definitely pay for ourselves on that front. So reach out. Now, finally, I would suggest that you continue to increase rents when you can, and remember that we can only increase them every 12 months. And make sure that you are paying the lowest interest rates, because things are getting back to being closer to neutrally geared. The more rent that you can increase, the better the interest rate you can get, the less of the gap. The gap is closing again. So it's really nice to make holding a property much more affordable. And I'd consider getting our strategic portfolio plan if you don't already have a plan, so you've got clarity on how best to create wealth and reach your goals. And that involves planning out what you do with your home, what you do with your investments, how you go through the various stages from building an overall portfolio to transitioning to retirement, and the different needs that you have and goals that you have along the way. So my crystal ball for the year ahead is rents, I think, will continue to increase over the next 12 months, and I'm expecting a further 5% rise. Immigrants are still favouring Perth. We've seen that from the latest population growth stats. So I expect that to continue. Maybe some uncertain times ahead internationally. There seems to be another negative news headline every time I turn on the TV. So I don't need to tell you about what's happening there. But it does also give people a flight into property and stable assets. So that's only going to sort of encourage the money to go into those. I know that those that are lesser experienced can think, oh, geez, should I do something? Should I just wait on the sidelines for these things to firm up? My advice is, when you can afford to take action, that you should, because there's always another negative news headline that's going to distract you. Now, we're seeing a lot of local investors still that are coming back to be attracted to the market with reasonable prices and rental yields still on offer and good prospects for the next 1 to 2 years. I'm seeing the first home buyers coming back strong. I'm seeing the upgraders moving into the middle strong. And CoreLogic was showing that the upper end was getting some money and some pressure pushing prices back as well. So I'm expecting a 5 to 10% increase in prices for those that are houses that are under 900K. This is just generally speaking. There's always going to be better areas than others. I'm expecting at least a 10 to 15% increase for the $900 to $1.2 million bracket. So I'm expecting that to grow the strongest over the next year. And I'm expecting a 5 to 10% increase in the plus $1.2 million bracket. For further help, reach out to get a updated sale appraisal anytime, whether you're refinancing, looking to use your equity to buy again, thinking of selling, happy to look at your home as well as your investment. And I really appreciate being that trusted advisor for our clients and helping them with their overall journey. So get in touch if you want an appraisal at investorsedge.com.au/appraisal. And for our property management, we're definitely one of the best in the country. Got that investment mindset focused on preventing stress and improving returns. Head to investorsedge.com.au and click on property management there. If you want to receive suburb intelligence reports on your areas of interest, make sure you get on over to investorsedge.com.au/join, where we publish those out, and they're really great reports to see what's happening and the underlying trends underneath. And finally, if you are thinking of buying or needing a strategic plan, head on over to investorsedge.com.au/invest and reach out, and we can chat about your situation and see how we can help. Thanks for tuning in today. I hope you've enjoyed the episode. If you have, like and share it with friends, and feel free to post a review. I love reading them all. I love seeing the comments on our episodes as well. I chime in there if you've got any questions. I hope you've enjoyed today's episode, and I'll catch you on the next one. Bye.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest, and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.